you do those calculations. Here's the sort of, I'll use the phrase again, arbitrage opportunity that exists when you're doing this planning. Again, let's go over the two we've talked about. We've talked about the fact that when you do this planning, you get a discount related to minority interest, marketability, those other limitations related to a closely held business and restrictions that you might have imposed on the stock. Okay, that discount. We've talked about the discount between the business as you think it's worth today versus what someone else might think it's worth today. Well, related to that, but a little bit different, is the arbitrage opportunity between the rate of return that will be prescribed by these tables or the code. Let's assume it's 8%. The code says you have to use 8% in calculating the annuity that you're going to pay out. Fine, you use the 8%. But let's assume that the effective rate of return, whether it's income that's generated, whether it's appreciation in the asset, is 9, 10, 11, 12%. That disparity, which I've called an arbitrage opportunity, it's simply a disparity between the rate that is used to calculate the payments you receive and the rate of growth or income or increase related to the asset that you surrendered. That's the game you're playing. If there's a substantial disparity between those two numbers, guess what? This has been a very profitable transaction for you, depending on the margin of that difference and the period of time over which it exists. Another way to do it, for those of you who are techies, you can call this a sort of internal rate of return. It's another way to think about it. What will the internal rate of return end up being on this asset that you've transferred versus the percent that you know what it'll be on the annuity? So if there's a gap there and it's a gap in your favor, then you can quantify that and you can see precisely how much you would have saved in taxes. And incidentally, at this point, we're not talking about just gift or estate taxes. We're talking about income taxes. And we'll get to that here in a few minutes when we talk about how you calculate the income taxes on these transactions, on the sale transactions. So I want you to get the underlying driving concepts here. And if you master these in talking about sales and asset depletion, etc., then you're going to be much more effective when you're talking with your lawyer. I want to go a little bit further down this road before I have to end this segment. We've talked about annuities and how they work. Before I go to the tax issues, let me move on to the installment sales and at least give you some familiarity with that. Then if nothing else, I'll deal with the tax issues in the next segment. Now, an installment sale is another way of dealing with the very problem we've already talked about. An installment sale, as you might imagine, means that you sell an asset and you don't take payments for life per se. Instead, you take a fixed stream of payments for a fixed period of time. Under Section 453 of the Internal Revenue Code, and maybe there are one of you out there who's now going to go look this up, but I just want you to know it in the event that you do want to follow up. Section 453 kind of defines an installment sale. It says that an installment sale means that you're getting some part of the payment after the year in which the sale took place. Simple definition. So it means that you could technically get half in year one and half in year two. That's an installment sale. Another way to do an installment sale is to have a stream of payments over a period of 30 years. That's an installment sale. But it's different from an annuity because it's not based on longevity. And many of you are much more familiar with that context. I mean, you buy lots of things on an installment basis. It's a routine way of doing business in America. As a matter of fact, our preference in America is get today, pay later. So that's a classic example. But Section 453 does limit the circumstances in which you can use this installment sale. One is with respect to exchanges of publicly traded securities. You can't do it there. And items for which there's a revolving credit plan. And these maybe the issue related to publicly traded securities, that may sink your boat in terms of some plans you had. So that's relevant to many people I talk to. But generally the issue about revolving credit plans, sorts of sales of merchants, etc., then that's generally not an obstacle in the estate planning context. So Section 453 talks about the whole idea of installment sales. Installment sales, you're probably already thinking, as we talked about how you do an annuity, how this might apply to you. It's just a little bit different way. It's taxed differently, not dramatically differently, but there are some issues there from an income tax standpoint. So you can see how this ties in with what we talked about with annuities. I mean, it has many of the common denominators. You know, you can still have the sort of discounts associated with minority interests, with control issues, with marketability issues. Those are still at play whenever you're talking about a transaction involving an installment sale versus an annuity. An installment sale, however, also you have a little more flexibility than you do with an annuity, because you can structure it differently and play with the interest rates in a way that you can't with an annuity. And here's what I mean. There's a concept called a self-canceling installment note. This is different from the regular annuity I just described. The regular annuity means you decide on a term for payment, whether it's 10 years, 15 years, 20 years, whatever that term is, and then there are payments made for that period of time, and at the conclusion of that, the asset is paid off. Now, if someone dies, though, with a regular installment note, if they die before all that's paid off, guess what? There's an asset in your estate. The asset is the value of that note. Remember, they received from your children. Let's go back to this example. You're selling a business, and you're selling it to your adult children. They give you this installment note. That note is an asset. Theoretically, and perhaps practically, you could go out in the market and you could sell that. Now, there'd be some discount associated with the risk of your son's payment. That's going to be an opinion that others might have about how conscientious of a payor your sons might be, or how stable your business is, but this is an asset. So if you die and that asset has not been fully paid off, in other words, it loses value with each payment, because the number of payments, the present value of what's owed on it, diminishes over time, of course. But if some of it is still not received at the date of your death, there is value that will be reflected in your estate, just so you understand that. Generally, it's not an issue. Most people don't do this planning thinking they're going to die 2 years from now. And generally, their thinking is correct, I hurry to add, is that it is down the road a little, and that's the best way to do the planning. So often, there's very little to no value left at the date of death. But for those of you who want more security than that, there is another way to do these installment sales, and that's the SCIN acronym, Self-Canceling Installment Note. What that says is that, look, if I die and there's still a balance owed, it's gone. It disappears. There's nothing more owed at my death, period, end of discussion. Now, many of you are thinking, that sounds suspicious. Why would the IRS permit such a mechanism? And as you might imagine, as you apparently have imagined, the IRS would pounce on that if there were not some offsetting provisions. So the offsetting provisions that makes this pass IRS scrutiny is that you have to have some adjustment in some term of the asset, of the transaction, that gives it that sort of arm's length viability. What that means is, why would someone do such a transaction in real life? If this were an arm's length transaction, why would the seller of the business accept such a note? Well, it would have commercial credibility if you change the rate of interest, wouldn't it? It would have commercial credibility if you changed the price, the value of the business, if you upped it so that the value of the installment note was higher. I mean, there are ways in which you can adjust the terms, the payout period, the interest rate, the principal amount on the front end. These are terms that can be manipulated. And if you manipulate them, then by definition, that reduces the requirement of the remaining terms if you adjust one of the terms upward. So in this case, you've got to adjust one of the other terms. So you increase the interest rate. So you increase the principal amount of the original note. Those would create the sort of credibility as a transaction that the IRS insists on. And that gets you across the line in terms of being assured that nothing is left in your estate. So this is a quick overview of how you might structure sales, annuities, self-canceling installment notes. I guess I should talk briefly, and I'll reserve this for next time. On the subject of sales, I really should talk briefly about a sell and leaseback. Those are frowned upon, and you have to handle them very carefully when you're doing estate planning, but it is a device that's used particularly with real estate. So I'll return to this issue in our next show. I'll talk briefly about that. I'll try to flesh out a little bit from a helicopter view of what's going on when we're doing these sales. My objective is, at the end of the day, this show will hopefully be very helpful to you in very tangible, monetary ways. Many of you have been through divorces, you're going through divorces, you're trying to think about your future, and we just want to be more helpful at Cordell & Cordell in that process. So this is Joe Cordell, another episode of Cash Counsel. See you next time.